Hello everybody, welcome to my channel. So I'm gonna be starting this new edition on this new series, really taking you guys through tax preparation for you all who are filing your tax return, what it means to file a 1040, the sections that go into 1040. So this is why you're like your tax professional, your tax expert, your tax guru, if you want to call it. So today, obviously when you start with your 1040 in this 2019, we went through the new tax law, the Job Act, the Tax Cut Job Act, who has been put into effect it started in December 2018 for the new changes in the tax laws and the tax regulations. There has been a couple of changes in terms of our tax returns, and what we see some people like, I didn't get a lot of money. These rules that are not really helping and not really benefiting me, especially the middle class are always complaining. But today what we're gonna do is we're gonna take them in segments, and I really want to break it down for you all to understand what goes into tax return, or when your tax professional or your tax preparer prepares your return. And they just give it to you without really explaining it to you, and you're like, I don't really understand this stuff. Like, what does it mean? So a lot of the return, obviously the front page of the return is always your 1040, which gives you the summary of the return. But if you are someone who have a lot of things going on, you have different schedules that comes along with your return. You can have like a schedule A, you have a schedule B, you have a schedule C, you have your schedule D, and some people can even go on and have your schedule F. So many schedules. So today I want to take the time to talk about schedule A. And what is schedule A? Schedule A literally just means your itemized deductions, and that's literally what goes into your medical expenses, your charitable contribution, your mortgage interest, your state withholding, which is known as your SALT, state and local tax. This is SALT. Now that's the new vocab that we kind of added onto it. It's like really like SALT, and you're like, what is SALT? State and local tax. That's what it means. And then we used to, in the past, before the new tax changes, we used to have miscellaneous expenses that can go on there, which can be like your employee reimbursements. The employee reimbursements, if you work, you can take some deduction from your employer. If you have investment, you can take your investment fees, but this time we don't have all of that given onto us. So that's kind of literally taken out of this. So I'm going to show you guys a document. This is literally from the IRS website, Internal Revenue Services, IRS website. And just this page right here, this right here is what I'm going to literally cover. This is the Schedule A. So I'm going to cover the schedule. So I want to discuss the difference between standard deduction and itemized deduction. So standard deduction is what the government have given you, whether you like it or not. It's standard, So often in time people kind of forget, don't understand what the difference is itemized deduction and standard deduction. Standard deduction is what the government has given you. So if you are not itemizing, you just take what the standard deduction is, which is what the government have given you. And this 2018 tax year and going forward to the next 5 years until new tax laws has come out, but to 2025, I guess, this is the new standard deduction that has been given onto us. For single, you get a standard deduction of $12,200. For head of household, you get a deduction of $18,350. For married filing jointly, you get $24,400. So those are the standard deduction. Just in case you're a single person and you have a house and you're paying a mortgage of, let's say, $15,000, that right there, because your house is that big, you have single people that have big houses, they pay, they live in the dream, I guess, and their mortgage interest could be $15,000. Therefore, that right there is higher than the standard deduction that the government has given them. So what they're gonna do is they're gonna itemize so they can get the bigger deduction, which is the $15,000. And on top of that, you have your SALT, which is your state and local tax deduction, which is capped at $10,000. And this is one of the biggest change in the tax laws and tax regulations that a lot of people are not so happy about, is the SALT. Like literally the government cutting that $10,000. So let's say you worked and your state, you make about $200,000 a year, or some people do. Well, let's just bring it to us who don't make a lot of money. And let's just say you made about $80,000 and you made about $100,000, right? And then you are paying the state withholding taxes for about, let's say, $15,000. Oh, that's even high. State deduction could be high, but yeah, it could be almost closer. You're paying state taxes about, let's say, $8,000 to $10,000, right? So that right there, and then you have real estate taxes that you are paying, which is another $5,000, or depending on your county that you live in, you pay high real estate taxes. So SALT has been capped to $10,000. So your real estate taxes and your state withholding, if you get a state withholding of $10,000, I'm gonna make the numbers even so it's more understandable. Your real estate taxes is $5,000, and your state your withholding for your state is $10,000. That's $15,000 right there. You can only take up to $10,000. You cannot take the other $5,000, the rest of the $5,000, because you are capped at $10,000, and that's what a lot of people are really pissed about when it comes to that law. But I think they need to really do something about that law, because a lot of state varies depending on the county that you live. You pay high taxes. I know in New Hampshire people pay really high real estate taxes. You know, even when you're in Maryland or you're in New York. Depending on the state that you are, you know, even Maryland, I can even talk about Maryland because I just recently moved out of Maryland. Even Maryland, different counties and their real estate taxes, laws and regulations. And sometimes, depending on the county, I know Prince George's County pay the highest real estate taxes in Maryland instead of Maryland. So if somebody has a house and they're paying about $6,000, $7,000 on real estate taxes, and then they have about another $10,000, literally they're only limited to $10,000. The $7,000 is just like a waste, you know, that they can literally itemize last year in 2018 on their 2017 tax return. But guess what, in 2019 they couldn't do that, and going forward they can't do that, because so that law was just really a bummer for a lot of people. But that's how it is. On the next thing is your medical. On the first items on the Schedule A is your medical and dental expenses. I kind of move ahead by talking about taxes paid. So I talked about SALT and I break it down. But the first thing on your medical and dental expenses. So if you have a medical expenses as in such that you actually paid, not your paying into your medical insurance company. What you actually pay if you went to the doctor, so you pay your copay and you had like a braces put into your teeth, and then you want to take those deductions because they are more higher expenses. You can do that up to your adjusted gross income, which is 7.5 of your adjusted gross income before you can even start deducting. So usually we tell a lot of people like forget it. If you're not like old with a lot of medical bills, or you didn't go through surgery, we like, please forget that. Don't even think about it, because you have to be able to hit the 7.5 of your adjusted gross income before you can even start deducting. If you haven't hit that, you cannot even start deducting. So a lot of the times, a lot of people don't even meet the standard, but some people do. I've had clients that meet the that 7.5 deduction. This year in 2019, last year it was 7.5, but now they've increased that to 10%, which is really bad. So if you don't have up to 10% of your adjusted gross income, you cannot take that. So the next thing is the interest you pay. So I kind of really cover a lot of these. The interest you pay on your mortgage, and I think there has been some changes also in mortgage in terms of taking second mortgage and all of that, which is about $750,000, but that's for another topic. We're just gonna cover this one. So you can take all your standard deduction. Your interest on your mortgage, you can take, if you pay $30,000 on your interest, you can take all that. So that's your mortgage and interest on there. And then we have gift to charity. You can take up to, so the new law is you can take up to 60% of your charitable contribution, which is really good. Like people like myself, we give a lot to charity. So, and obviously I run my own non-for-profit organization, so I donate a lot of money. So I can deduct all those, but I don't think I'm gonna be able to. About these new tax laws, I don't think I'm gonna be able to deduct any of that. So then that's the next. So if you pay to goodwill and all of that, you can deduct all those charitable contributions. If you have casualties and theft losses, you can also take that. Like I said, the new tax law does not allow you to take miscellaneous expenses like employee reimbursements and all of that. Employee reimbursements, you cannot take all of that because they've taken that out of the law. So if you go to work and your company does not reimburse you for your certain supplies and all of that, you can deduct that on the tax laws. Family friends, this is to cover the itemized deduction part of the new tax law and the new tax changes. I hope I was able to really clarify the difference between standard deductions and itemized deduction. Like I stated earlier on, if you are not hitting those high numbers and you are just in a lower level, you don't have a home and all of that, please forget about itemized. So just take the standard deduction. If you are single, $12,200, and then if you are married, $24,400. If you're head of household mean, and I'm gonna do more, series to cover all of you who really falls under head of household. People don't understand what it means to be head of household. I'll cover all of that. But head of household is about $18,350. So you take those one and don't worry about the itemized deduction. Thank you very much for your time. I hope that I was able to cover this series and this portion of the tax laws very well to your understanding. If you have more questions, just reach out to me. Thank you very much once again. This is Viola Teba Yanyi Amper, your tax expert. Don't hesitate to call me. Have a good day.